Hi everyone, this is a short screencast video for our homework for week 1. So these questions are on page 295, questions 1 to 4. And the main areas that we cover within these questions are really tax credits and tax bands subject to the status of the individual. So for question 1 here, we have an individual called John. We clearly see that John is employed by A as an engineer. He has a wife. She's a full-time housewife and she looks after the couple's 3 children. We're given some details on John's salary, which was 50k for 2014. Now, the requirement clearly states compute the income tax liability. So basically, we've got an income tax computation. And we should know from our studies that an income tax computation has several different parts and it needs to be laid out in the correct way. Now, we'll see when we look at the answer how to lay out that income tax computation. But for the purposes of this tutorial, what I'm going to do now is just go back over the question and see what hints and indeed tips we get when we read the question. So we know that it's an income tax computation. So we know that we're going to have to lay out an answer, an income tax comp in the correct format. But what are we going to have to put in it? Now, the first thing that we see within this question is that John is employed. And that must mean a tax credit. In other words, an employee tax credit. So we've got to remember to stick that in at the bottom of the income tax computation. We also see that John has a wife, therefore he is married. And in addition to the employee tax credit, we must think, well, this individual or the couple as a unit are going to get the married tax credit as well. In terms of the information in relation to John's wife's salary, we see that she's full-time as a housewife, therefore she is not working, but she is looking after the couple's 3 young children. Now that should give us a prompt that there may well be another tax credit available to her. So we've just got to think as to what that is. So it looks to me so far is that we have a simple comp. We may have 3 tax credits. And this is a married couple. So it seems to me that their band, in other words, their tax band, is going to be based on a higher figure. Okay, so that's the basic setup of the question. Let's have a look through at the answer now. Now, a couple of things I'll draw your attention to here, just broad things. You may not think they're important, but they will be as the income tax computation questions get more complex. Yeah. Now, the things that I'm going to refer you to really are the layout first. As we said within the classes, we've got 2 columns here on the right-hand side for the numbers. The narrative is all on the left-hand side. What they could have done here is perhaps lay out a title. Perhaps here, income tax computation, John Sally for 2014. So there's the basic setup of the answer. So what do we need to do to get this answer right? Well, what we should know from an income tax computation is that we're including all income gross. Yeah, so we have the gross figure for the salary. We're not given any other information in relation to income. So that's the only thing that we need to include as salary or as income, 50k. So if we have the gross income, it looks like we don't have any deductions at all. Where do we go from there? Well, we're going straight into the bands. In other words, the bands for a married couple under joint assessment. What does that mean? That basically means one computation. Now we should know, or we could know from our tables, that the band, the basic 20% band is 41.8. Okay, we'll get that information, as I say, from our tables. Now, Sally doesn't have any income. She doesn't have any income. She's a full-time housewife. Therefore, there's no need for us to consider any increase to the band. So we simply take 41.8, multiply it by our 20%, get the 8360, and obviously the balance from the 50k is at 41%. We get the total figure of 11,722, and then all that we need to do is think about the next part of the income tax computation. In this case, it's reasonably straightforward. We know that the next part is tax credits. And if we think back to our question itself, if I just move you back to the previous page, because I've annotated the question itself, it's easy for me when I get to that part of the income tax computation, i.e. where the tax credits are, I can just go back to the question and say, I'm just going to take it one by one. There's definitely an employed one. I know what that is. I know that it's 1650. There's definitely going to be some sort of married tax credit because they are married. It says wife, therefore we must have 3300 included. And in addition to that, it looks as if there are 3 kids, they're being looked after by Sally. Then I would suggest that the home carer credit is also going to be available. Okay, so if we look back at the answer now on the tax credits area, you'll see that very simply all that they do is simply list each of the credits. There's the married one. I'll come back to the home care in a second. There's the employee one. He is employed, therefore he's entitled to it. Now this home carer issue, when does or where does the home carer credit kick in? This one here, how would we have known? Well, basically, the home carer credit, as you see, it's 810, and that will kick in where we have one of the spouses, in this case, a wife, caring for either a child, someone greater than 65, or an incapacitated person, So it's either 1, 2, or 3. Now bear in mind, we cannot get this home carer credit if the full-time housewife cares for a spouse. It's only in relation to these items: child, someone over 65, or an incapacitated person. Okay? Now, the other issue that's not relevant in this question is that a couple cannot claim the home carer credit and claim to increase their married couple's band. Now in this case, as you'll see that, that wasn't relevant because Sally didn't have any income. In other words, because she didn't have any income, we were never going to increase the band anyway. Their band was 41.8, based obviously on his income. She had no income at all. So there was no issue between us choosing to increase the band or to use the home carer credit. You should remember that in class we did a question on this area where, yes, you can claim the home carer credit, but you can't also increase the band. So we have our 3 credits here. We're simply listing them. We have no details on PAYE for John, so we don't need to include that. So each of these credits, and we didn't have to split between refundable and non-refundable because these are all basically non-refundable. These are all deemed, but in addition to that, the total value of the deemed credits is less than the tax liability. So we had no worries about whether or not a non-refundable credit was going to be refunded to the couple. And if we just take the difference between the two, we get the income tax payable. Okay? So there's the first question there. Let's move on to the second one. Now in this particular case, it looks as if we have a couple, Jenny and Paul, and they make it very, very clear that they are not married. Okay? They are not married. They have a child, and Jenny cares for that child Monday to Friday. Okay? In addition to that, the child lives with Paul at weekends. It looks to be that they're both employed because we're told that they have salaries. A salary means Schedule E. It means that they're both employed in jobs. And they have salaries of 35k and 30k respectively. We're given some information about Jenny being the principal carer, for the single person's child carer credit. Now in the real exam, they'll simply say something like, Jenny is classified as the principal carer. They won't say for the single person's child carer credit. They won't give us that prompt. Other than that, in terms of the basic requirement, what they've said is simply calculate the income tax liabilities for both individuals for 2014. So there's the basic setup. Now, if I read it again, what do I think about the information that they've provided to us? Well, quite a few things really. The first one is that they've clearly said that these individuals are not married. Therefore, they cannot be assessed under what we call joint assessment. So if we're not assessing under joint assessment, we've got to have two income tax comps, two separate income tax computations, one for Jenny and one for Paul. Now, in those computations, I would have thought that they're each going to have a tax credit. In other words, a single tax credit. Bear in mind, they're not getting the married tax credit because they are not married. That's the first thing. The second thing is that we're given some details about Jake, and also who looks after Jake. Now, kindly in this question, they detail the fact that Jenny is the principal carer. Now, what we should remember by that is that the principal carer is the one that is going to receive the single parent credit, not the person who isn't the principal carer. Obviously, it can be transferred, but I would have thought that in the main, the person who is the principal carer is going to receive the credit. Other than that, we see the salaries, they're quite easy to deal with. We're just going to slot them in as gross income. So for me here, we have the credits relating to the fact that they are single individuals, but we also have the credit relating to the fact that there is a child and that there is one principal carer. Okay, so that's the basic setup of the question. Let's look at the answer now. Let's deal with Jenny first. What do we know about Jenny? Well, several things. The first one is that, in effect, she's going to be taxed as a single person. So what does that mean for her income tax computation? Well, basically, let's just set it up. I might have written here, perhaps, income tax computation. What do we do first? Let's just put her income in, her gross income. That's her salary at 35. Now note that as she is classified as a single person who's caring for a child, she should be in a position to receive an increased band. In other words, an increased basic rate band. And in terms of that figure, really what she can go up to, remember we talked in classes about status, she can go up to 36.8 because she is in effect a single parent, or at least classed as a single parent. So that's the reason that her salary of 35 is all taxed at 20%. Okay? So if we tax that at 20%, we get a figure of 7,000. Now, there's no deductions, so where do we go from there? Well, we have to go to the tax credits. And what do we know about Jenny? Well, the first thing that we know is that she must get a single credit. She's not married, so she must get something. It's either the married or the single. So she's going to get a single credit, and that kicks in at 1650. Now, they prompt us in the question above, they've said that basically she is going to be classed as the principal carer for the single person's child carer credit. How much is that? Well, that's 1650. So there's the 1650 kicking in. What does she have over and above that? Well, we're told above that they both have salaries. She must get the employee credit. And we know from our studies, hopefully, that is 1650. So there's another 1650 to add into the pot. We simply take each of those credits to get to 4950, and then we're simply looking at the difference between the total liability, the tax credits being 2050. Okay? And they clearly state, obviously here, net income tax payable. So that's Jenny dealt with. What about Paul? Now, his circumstances are slightly different. Albeit for the fact that he has a salary, and that's the only piece of income that he has. We obviously include that. We're going to be taxing him at 20%, but bear in mind that he wouldn't get the increased band. He would just get the normal band, but it's not relevant in his case because of the fact that his salary is only 30,000 anyway. Okay, so 30,000 at 20% gives us the 6K. What do we know about his credits? Well, we know that he's definitely not married. Therefore, he's going to get the single credit. That's 1650. He is not getting the single person's child carer credit because Jenny is the principal carer and she hasn't transferred it to him at all. Okay, so other than the single person's credit, he's simply going to get an employee credit because he is employed. Okay, again, we're not given any details about PAYE, so we just have to ignore PAYE. So what does that give us? That basically gives us total credits of 3,300 less what we have here in terms of the liability. The difference between the two is the income tax payable of 27. Okay, so let's move on to our third question here. It looks as if we have a death here, so it may well be that another credit is going to be relevant to this individual. We've got an individual who's died in October 13. Now, that seems to be significant for me. They've given us information first. That's in the 2013 year, not the year that we're doing the income tax liability for. So what else do we know? Well, we know that his wife, his widowed wife, is in effect working as a nurse. So he died, he did have a wife, therefore there was a marriage. Yeah. Now, her earnings for 2014 were 50, and she also has 2 children aged 14 and 16. In terms of the requirement, we're simply asked to provide an income tax liability for 2014. So when I think about that question, I can see my answer as I could have within the questions 1 and 2. I know that it's a simple comp. Let's make sure that I get it set up properly. Okay? Now, if I read back the question and try and pick out, well, is there anything that they're telling me that's going to be useful when I do the computation? Well, as soon as I see that word there, I'm thinking to myself, well, it may well be that there's an additional credit available because she is in effect a widowed spouse. So I've got to think to myself here, tax credit, and I'll be annotating the question as I move down it. Now, they do say that his wife is a nurse. Now, they don't say that she's employed, yeah? But in the absence of any information to the contrary, we have to think to ourselves, well, they haven't said that she's a self-employed nurse or that she's a nurse who's freelance under case 1 or case 2. So we have to really think to ourselves, well, she must be employed. Now, it may well be that, this question, the wording is not quite as straightforward as it would be in a real exam, and I think that's probably the case here. I would have preferred them to say his wife Nora is employed as a nurse, because then I would have known, well, there's going to be an employee tax credit here, for example. What else do they give us about her? Well, they say earnings were for 2014 were 50k. They also say that she has 2 children. In other words, that she is looking after 2 children. Okay, so if we look at the answer now, in terms of a setup, reasonably straightforward. Again, same old thing here. We're just starting off with gross income. Schedule E, that's the only information that we're given on income. Therefore, that's what we must include as gross income. There are no deductions, none mentioned in the question, no pensions or anything like that. So, what do we know about bands? Well, we know that now she's in effect a single parent with kids, yeah? And therefore, the increased band must kick in, just as in the previous question. In effect, she's going to be receiving the single person's child credit, therefore a single band, the increased band is going to be relevant to her. So 36.8 at 20, yeah, that gives us the 7360, and obviously the balance at 41, giving us a total figure of 12772. Then we've got to be thinking about tax credits, and you remember when we went through the question above, we have this sort of annotated, I should have probably said there, employed, therefore there's a tax credit there. There are also some details about kids. We've got to think about tax credits there, okay? So several different possibilities for tax credits. Let's deal with them in order. The first thing that we have, and the one that I would always put down first is, based on their status. She's a single person now, yeah, because obviously her partner has died. Therefore, the single credit, apologies for that, the single credit is available to her. Not the married credit, it's the single credit. In terms of the single person's child carer credit, basically, they haven't said that she's the principal carer, but there isn't anyone else. Her partner is deceased, her husband is deceased. She must get, if she's looking after kids or if she has kids, a single person's child carer credit. There's the 1650 kicking in. The employee credit, I'll come back to the widowed parent credit in a moment. The employee credit, she's employed, or we've had to assume that she is employed. Therefore, the employee credit is available to her. No information on PAYE deducted, so I completely ignore it. Okay? So we've got 3 so far, yeah? Now, this widowed parent credit, this is one that catches students out from time to time. The key thing with this is that this credit kicks in or is available the year after death. Yeah, the year after death. Now, they were quite cute here, and this is what I expect them to do within the exam. They were quite cute here because they tried to confuse you a little bit. Yeah, so they said that he died on the 1st of October 2013, which must mean that the year that we're doing the income tax computation for is the year after he died. Therefore, it is year 1. So do note with this widowed parent credit that it kicks in the year after the death. Now, what I would expect them to do in the exam is to perhaps make it even more complicated. In other words, to say to you something like, rather than the individual dying in 2013, maybe they died in 2011. So what you'll have to do, obviously, is, start from, let's say, 3-6, we know that that's year 1, and say, well, if 3-6 is the starting point and he died in 2011, what was year 1? Well, year 1 must have been 2012, therefore year 2, if we take 450 off it, would have been 2013, etc., etc. So what they've done here is slightly sort of confusing, but not as confusing as they could make it. Okay? They've only given you a 1-year gap, which means that you're effectively starting for this widowed parent credit in year 1. Yeah? So you're starting at the full value of 3-6. I would expect them to start you maybe 3rd or 4th year. And bear in mind that it only lasts for 5 years. So you go year 1 to year 5. In effect, it will go down to 1800. Okay? So watch for that. That's a very, very common trick in the F6 exam. So we have our 4 credits. We simply total them up. The difference between the 2 here is obviously the income tax payable. Okay? So let's move on to the next question now, the 4th one. Now, I do think there's an error in this question, and I'll point it out to you in a moment. So what do we have here? We've got Jack married to Jenny, 67 years old. Since I see an older person, I've got to think, well, maybe that there's some additional tax credit or something that they're going to get over and above normal tax credits. And that is the case in this question. His wife is 63. I think the key age is 65. So we've got to think to ourselves, well, he's 67, she's 63. Does that impact upon what he's going to get, or doesn't it? Now, in terms of his income, they simply say that he received an old age pension of 10,000 together with an occupational pension of 25. Now, when you think about these types of income, basically don't be worried. I mean, these are just income or gross income for an individual. Just because it comes from a pension doesn't mean anything. They're still going to be taxable up to a point, and this is where the error within this question comes in. So, in terms of what we're required to do, we're required to, again, produce an income tax computation for 2014. We're ignoring PRSI and USC. Just remember for the moment, this will come later on in the course. These are just additional sort of levies or additional taxes that the revenue apply to individuals and that are payable by individuals. So that's the basic run through the question. What do we think in terms of detail here? Well, let's look at it from the perspective of how their answer works, which is incorrect. But let's just assume for the moment we're just reading it, we're going to do their answer. The first thing, obviously, that's relevant for Jack is that he's married. Yeah? Therefore, there must be some form of tax credit. The next thing is that it looks to me as if he is in excess of 65. Now, that's often where you get things kicking in for individuals. They do say that his wife is under 65. I think that's a little bit of a curveball if we just assume that the answers are correct for the moment. I think that's a curveball. In other words, it's a sort of a trick that the examiner is playing to put you in a position where you think to yourself, well, okay, but his wife is less than 65, then maybe he shouldn't get any increased allowances. Over and above that, they give some details on income, fairly straightforward, just 10 plus 25. So if we look at the way that they've laid out their answer, you'll see that they've gone at it from the perspective of very simply that everything is taxable. So let's just run down that for a moment, then go back and correct ourselves. So what we see is Schedule E. We'll remember that old age pension and indeed occupational pensions, they are normal Schedule E income, so the taxed at source. There's the 10 and the 25. So his total income is only 35,000. What do we do with that? Well, he's a married individual, so he would have, in normal circumstances, an increased band, and an increased band at 20%. So that's why the 35,000, or all of it, is being taxed at 20 to give us 7. Now, in terms of the tax credits, what we'll see here is that the normal tax credit, married person, seems okay for the moment. We'll see that 3,000 is kicking in. In addition to that, because this individual, Jack, is older than 67, he's going to receive what we call an age allowance of 490. And then over and above that, because he has Schedule E income, in effect, an employed person, he will get the employee credit of 1650, although that wasn't specifically made clear within his within the question. Just let's try and remember that someone receiving a pension income under Schedule E is going to get the employee credit. So what they do here, obviously incorrectly, total all the allowances. Do note here that this 490 is available in full because this individual is married, and actually we weren't concerned about the fact that Jenny was 63. In other words, if you're married, if the main partner, Jack in this case, is over 65, even if his partner is under 65, he can still get the increased, the increase. Remember that for a single person, it would be 245. But for a married couple, as we see above, it is 490. Okay? Now, the way that they've done it in the question, obviously, they total the allowances. The difference between the two is the income tax payable. Now, the key point here really is the fact that his income is lower than 36k. And as a result of that, technically, he shouldn't have to pay income tax at all. In other words, he's in a position where he's a low earner as far as the revenue are concerned. Therefore, he shouldn't actually have to pay tax. So really, this is an error. This question is incorrect, really, because of that figure. So do check back in the relevant chapter for what we call age exemptions. Age exemption. In other words, for a single person, if they're over 65, we have an 18k limit, 18,000, and for a married couple, 36,000. So that's why I make this question inaccurate. Okay, so hopefully that's been helpful to you. It's just a very, very quick run through these questions. These tax credits are important. As I've said within class, the easy marks, what I call the cheap marks, are very important. We can't ignore them, and most of the tax credits are fairly easy to deal with. So when you're doing income tax computations, focus in on the tax credits. Also focus in on the bands, this area here, where do individuals get an increased band and where do they not? Okay, that's an area that your examiner is going to target. Okay, so hopefully that's been helpful, and good luck with your studies.